I realize the perils of holding on to of these ETFs too long and the stocks aren't trending, then investors may not have a return profile that's going to meet their expectation.
All right, joining me will be Matt Markiewicz, head of product and capital markets at Tradr ETFs, which the Tradr brand has been around about a year and a half now. And already they're up to some 65 ETFs approaching $3 billion in assets. They've been a really nice ETF success story. And their focus is in the leverage and inverse ETF categories. So specifically, they offer leverage and inverse single stock ETFs. They also have leverage and inverse ETFs covering the Qs and SPY that reset on a monthly or quarterly basis, which I think is a unique twist. And then they have an inverse ARC ETF as well. And so Matt and I are going to discuss this growing lineup. We'll talk about exactly how and where Tradr ETFs is finding success at the moment. And then we'll touch on the importance of investor education around these products, which everybody knows I always like to talk about. So this should be an interesting conversation on a very hot category of ETFs right now. So I'll start there this week. And then later, I'll be joined by Christian Magoon, founder and CEO of Amplify ETFs, who they're now at 40 ETFs, over $20 billion in assets. They actually grew assets by 70% last year. If you haven't been paying attention to Amplify, they just continue to rocket up the ETF leaderboard. But they have a unique suite of ETFs themselves that spans options-based strategies, thematic strategies. They have some core portfolio strategies as well. And so Christian and I are going to have a fairly wide-ranging conversation around that ETF lineup and why it has been resonating with investors. And just to give you a flavor, they have ETFs such as the Amplify Junior Silver Miners ETF. They recently launched 2 ETFs centered around stablecoins and tokenization. They have the flagship Amplify CWP Enhanced Dividend Income ETF. That has some $6.5 billion in it. Again, it's a unique lineup. And I'll tell you, Christian is someone I always enjoy visiting with. He's been involved with ETFs going back 20 plus years now. And he always does such a great job of communicating concepts in a way that everybody can understand. So I think you'll really enjoy that conversation as well. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, to start this week, let me now welcome in Matt Markiewicz, head of product and capital markets at Tradr ETFs, who's joining me from Connecticut. Matt, it is so great having you back on the podcast. How have you been?
Thanks for having me, Nate. I've been great, and it's good to finally be here when we can actually see each other versus doing this on the phone, which we've kind of done that dance for the past few years.
Well, it's great having you back on here. And I thought let's start with that growth that I was mentioning at the top with Tradr ETFs quickly approaching $3 billion in assets. I believe you're currently at $2.7 billion, just to be exact. But I show you were at around $700 million last March. And so what has gone on over this time frame? How did you go from 700 million to 2.7 billion in such a short amount of time?
Well, when we launched the Tradr brand in May of 24, we really did it with the intent of focusing on products that we knew that we were good at launching and marketing, and that innovation bent has really helped us to focus. And part of that focus was continuing what we pioneered in this industry, which we were the first provider to launch single stock ETFs. So this is a leveraged strategy on just a single equity. And we did that back in July of 2022. So we're coming up here close to 4 years being the pioneers in that space. And so with that focus, we said, we got to start launching single stock ETFs, really take a look at the market and set an aggressive launch plan. And as you noted, we kind of launched over 60 single stock strategies last year. And, most of them on the long side, 2X long, and a few on the short side. But that's how we did it, just with a really focused and aggressive launch plan.
Yeah, and with that aggressive launch plan, I'm curious, how are you approaching product development at Tradr? In other words, how do you know what might work and when it might work, especially in the single stock ETF category?
Yeah, so you never really know, right? But you come up now. Now this is my 19th year in ETFs, and you come up with sort of a good idea what investors may want. And you got to also think about what's the investor audience that you're trying to reach. So for us with the single stock ETFs, it's self-directed investors. So people who are trading their own accounts on Robinhood or Fidelity or Schwab, for instance. Um, we also have a fairly large overseas cohort of clients because it's pretty much not you're not able to trade on margin in most overseas platforms, China, South Korea. So these leverage products have been very popular in those overseas markets. So yeah, again, like we're really focused and we know who we need to go after. The typical financial advisor is not our focus, for these types of products in general. And we'll touch on this. They're not appropriate as a fiduciary for clients, right? So we really focus on that self-directed market, and I think having that focus has allowed us to really maintain a brand and kind of build our reputation within that audience.
And again, with that aggressive approach to the market, just in terms of launching products, I have to ask you, do you have any specific launch goals this year? Should we continue to see more of this from Trader ETFs?
Yeah, I don't think we'll be as aggressive as last year, but I think you could expect kind of between 3 and 6 per month, for the rest of the year here. Uh, I don't want to say a lot of the low hanging fruit has been picked already in this single stock ETF game, but that's kind of the challenge now, is identifying uh, companies. It's more in the SMID space, Nate, that like maybe exhibiting really good volume uptrend patterns or price action or volatility patterns. At the end of the day, it really has gone to show that the traders, the short-term investors that are using single stock ETFs are attracted to the volatility, right? So something around a single stock ETF around a Procter and Gamble, for instance, not something that we probably would look to launch anytime soon, because it doesn't have the ability to move 5-10% a day based on that underlying stocks movement.
So I think that's a perfect segue here because I was looking at the Trader ETF lineup, and I see that the Trader two times long SanDisk daily ETF, ticker SNXX, that's currently your most popular ETF by assets, and it's gathered something like 700 million in less than a month of trading. And so I guess a couple of questions here. One, has that been your best launch up to this point?
Absolutely, it's been just a standout. And we are. It definitely caught us by surprise. We knew there was appetite there, just given not only the fact that SanDisk was the best performing stock in the S&P 500 in 2025, which probably a lot of people scratch their head about that one, but it does have some volatility. The underlying stock trades, some days up to $8 billion a day. So there definitely was pent up demand there, but I'd say I think it caught us by surprise to the upside a little bit, which of course we're happy about. But yeah, it's far and away been our runaway, home run best launch ever for Trader.
And that was actually going to be the second part of my question is whether or not you were surprised by the success. And it sounds like a little bit, but I guess going back to the product development side of the equation, and we don't have to get too far in the weeds here, but talk about SanDisk and putting it in the ETF wrapper like this, why that was attractive. Does it come back to that volatility profile again?
Yeah, volatility and also the fact that it's trading, anywhere between $4 and $10 billion a day. That underlying stock, it is the darling of the momentum trade right now, pretty much. And I think I'm pretty sure it's also the best performer year to date in 2026. So just a clear momentum name. It's loved by swing traders, right? Who are kind of buying any dip they can. The company announced a secondary. This, as a reminder, SanDisk was spun out from a company called Western Digital. Yeah, it's conceivably an old stodgy hard disk drive manager, and the ticker on that is WDC. And we also launched a WDC two times long ETF the same day we launched the SanDisk ETF. And WDCX is that ticker, and haven't had nearly as much interest in that one, although it's had close to 50 million at one point of assets, which is still great by any issuer's standards of success in less than a month. It's we were surprised again that the uptake has been this aggressive, and a lot of it, not only is it coming from the U.S., but we see a lot of pre-market activity. It traded close today, close to 1 million shares pre-market, almost $50 million worth, which is again stunning for an ETF just a month old.
You were touching on this a little bit earlier, but with leverage single stock ETFs in general, can you talk more about who's buying these? You mentioned retail investors. I'm curious in more detail, what type of client specifically, or what client segment are you seeing the best penetration in with these products, and why do you think that is?
Yeah, for as you said, it's the self-directed investor again on your Schwabs, your Robinhood, E-Trade, eToro, some of the smaller platforms, Webull, for instance, and really it's an extension of I want to say the resurgence of the retail trader. You read a lot about that, but a lot of the action in our ETFs is from that U.S. based self-directed trader. So just high turnover. The funds kind of on average are turning over about a quarter of the assets every day, which is think about like an EEM or a IFA or something like that. You don't nearly see that type of action every single day, right? So a lot of day trading, which is again what the products are made for. And again, as I said, we are seeing interest from Asian investors, particularly South Korea and some China, who are again can't get any leverage, and they're interested in these themes of the memory trade, the AI infrastructure build out, and the picks and shovels related with that. Some of the the AI enablers, if you will, Bitcoin miners turned providers of high power compute assets, right? Clean Spark, IREN, and these are stocks that you don't have these types of companies overseas. So we do have a lot of overseas investors in the products.
When you talk about self-directed investors using these products, I know one of the narratives that I'm sure you've heard out there is this concern around self-directed investors not understanding how some of these leverage and inverse products work. And so I'd love to have you talk more about investor education in this space overall. And I know we've covered this topic before, but I just think it's so important in this category because unfortunately, I do think there are some investors out there who simply don't understand how leverage and inverse products work. And so there is the potential that they could get burned. So talk about that and perhaps how Tradr is trying to help with this, just help with education overall.
Yeah, to level set, I will say since I started on this leveraged ETF journey several years ago, the questions have gotten to be way less in frequency, which is great. You have new entrants into the market, of course, but at the end of the day, it's obviously all over our website. It's in the prospectus. We do get a lot of calls in. Hey, can you explain why this is happening? A lot of what I feel now, more of the questions, Nate, center around intraday trading, not necessarily point to point, right? So if you buy a leverage ETF on Monday and it's on a single stock, and that single stock, excuse me, is up 5% for the week, that does not mean your 2x leverage ETF is going to be up 10%, right? Because it's all dependent on the path of those returns throughout the week. We've gotten a lot of less of those questions where we kind of still seem to get some more feedback, if you will, is a lot of the ETFs, when you launch them, they don't trade a ton on screen. So the liquidity, if it's trading 10,000 shares a day. So the single stock ETF may not always be the last sale, may not always be reflecting what the stock is doing. So we get a question like stock XYZ is up 5%. Your ETF is only up, your 2X ETF is only up 8%. What's going on? Then you have to kind of educate people. Well, listen, that's the job of the market makers. And you have to watch the bid-ask spread. It's not the last sale. So there's been a lot more of, I would say, of that, especially as we get into and we launch products that are more on the small cap side, anywhere in the $1 billion to $5 billion market cap for some of these single stock ETFs, where the stocks themselves may not trade a ton. So again, that's part of the product development process and ideation, is to making sure that the underlying stocks are trading enough so that we can have a nice, really, liquid on-screen market throughout the entire day.
But it sounds like with the daily reset leveraged products, you feel like investor education has improved in this space.
I just say knowledge. Yeah, knowledge is greatly improved. Like I get a lot less. I don't trade these anymore because I got burned. Right? It's like, I tried them. I realized the power. I also realized like the perils of holding on to of these ETFs too long. And if there is a lot of volatility and the stocks aren't trending, then investors may not have a return profile that's going to meet their expectations. And that I think it's again just based on the number of calls that we get in emails. A lot of that has died down over the past year, and maybe we've kind of reached peak investor entrance into this sector. I don't think we have, and we can touch on that a little bit. But like overall, again, that's sort of the negative feedback that we've gotten and the negative comments. It's like I don't understand why this has done this. They've gotten to be much less over the past couple of years.
And I think a related topic here. So I agree with you. I think that education around these products has improved overall, and I think that goes hand in hand with just the rise of the retail investor that we have seen. Perhaps that goes back to around the pandemic timeframe when we knew a lot of people were at home and trading. Can you talk more about that? Just the rise of the retail investor, because I think that's been an enormous trend in ETFs again over the past 5 years or so.
It has been, and again, thankful for us launching the single stock ETFs. It's been a real boon and a some wind in our sails for our business. It's driven by a couple factors. Options trading, Nate, has exploded, and a lot of that has been driven by retail. I don't know the exact numbers. I'm sure Citadel or somebody has that, or to think about that. But options are a derivative, right? And leverage ETFs use a derivative to get their leverage exposure. So kind of that explosion in option trading and the use of leverage ETFs goes hand in hand. We would expect kind of around this time of the year, Wells Fargo had a note out about a week ago. It's the return of the YOLO trade, right? Everyone gets their tax refunds, no matter how big or small they may be, but expecting, I think it's about $150 billion of liquidity by the end of March from people's tax refunds. A lot of that's going to go into the stock market, and a lot of it's probably going to be from self-directed investors trading options or leverage ETFs. So that's helping to drive I think this increase in usage of derivatives based products. I mean, you've had other issuers on before with all the different style options, income products. That it's a generational shift, really, right? These are not our parents' ETFs. And I mean, geez, my mom only knows ETF because I'm in the industry, but you know what I mean? It's a divergence from your plain vanilla, SPYs and VOO type of ETF, right? So that retail embrace of options and ETFs again has gone hand in hand. And I just remembered the number. It's about the estimation from that Wells Fargo note. It was about 25% of options trading these days is from retail investor. So think about that. Like that's all sort of what you would call our target client, right? So if Greeks are a little confusing to you, hey, when you come over to the single stock leverage ETF pool, the water's a little warmer over here. You don't have to really be such an options expert to understand exactly what is at risk, right, in terms of your principal, and what you're expected to the expected return for that day, of course, is.
And with the single stock ETFs, you mentioned these holding derivatives. Do you want to just talk a little bit about how you get exposure within these?
Yeah, so we use something called a total return swap, and that is a contract that we have with a counterparty. It's all on our holding site, completely transparent on our website. We have depends on the fund, but anywhere between 2 and 6 counterparties per fund, and that number is a growing number for us, so that we can diversify that risk. And that total return swap simply says, this exposure that you have for, let's just take SanDisk, Nate. We will guarantee you 2 times the return for SanDisk on this day, right? And so it's a very clean way of doing it. The fund, in essence, holds all cash. So there aren't any other, for our purposes anyway, we don't have any, government treasury funds in there. We have the cash gets a small interest from our custodian in a sweep account. So you are earning interest on the kind of long side to offset some of those swap fees. And yeah, really simple, clean. And again, if anyone has, any interest in learning about, kind of how to read the holdings on the website, happy to kind of do that. But at the end of the day, the fund is pledging cash and it gets a return from a counterparty on the other side.
A few minutes left here. I know besides the leverage and inverse single stock ETFs that Trader offers, I remember last time we spoke, you had just launched the industry's first non-daily reset leverage ETFs. I think that was back again around September 2024. So I'm talking about products like the Trader 2 times long Innovation 100 quarterly ETF, ticker triple QP. There's the Trader 2 times long SPY quarterly ETF, ticker SPYQ. Do you want to offer a quick snapshot of these ETFs just in terms of how they work? And then I'm curious, how have they performed relative to the daily reset products out there like QLD or SSO?
Yeah, I think as we were going down the path of exploring, some non-daily ideas in the spring of 2024 when we launched the Trader brand, we're talking to some tactical RIAs, right? So they manage tactically. It's not just kind of 70-30, 60-40 profile portfolio and just forget about it, right? There's a massive cohort of actively managed RIAs out there, tactical managers. And we were talking to kind of some of them about what they would like to see. And, again, that daily reset product of the, that you mentioned on the SPYs and Qs, it can be very subject to decay if the markets aren't trending, right? So for their standpoint, and, some conversations that I'd have with advisors at the time who are in those products, they're not appropriate for a longer term investment. You're using a daily return product for something that you're holding for months, or even some of these advisors were holding them for years. And that's a bit of a mismatch in kind of, if a client indicates, hey, I'm okay taking some risk. Well, some risk is not, an ETF that has, some of the highest volatility out of all the 4,000 ETFs, in the United States. So that's where we came up with the idea for this, monthly or quarterly reset, which has existed in mutual fund form for about 10 years. So, we mirrored that, kind of strategy and just put it in an ETF format. And it has been, it's been, as you mentioned, we launched the monthlies in September of 24 and the quarterlies in October of 2024. And, to your question about performance, it really depends on, what kind of regime you're comparing it against, relative to QLD or SSO. There's this concept of path dependency that I spoke about earlier. That's just so important when you're trading leverage ETFs. And our non-daily reset products are less path dependent. Meaning, for instance, let me just kind of give an example. MQQQ that seeks to give investor 2 times the monthly return of the Qs, right? But before fees and all that. So point to point, and that's starting the month off, the last day of the prior month, and then the last day of the following month. That's where you're getting that 2x performance, right? So you're kind of not riding that volatility throughout that period. So kind of a good place to use something like this would be, maybe during earnings season, where we do see more volatility. Or if you look back and look at the historical volatility of SPYs or Qs during a particular month, you're bullish on U.S. equities and broader market equities, and you want to take that bullish view up a notch. You can really use one of these products during one of those more volatile times. When we had the tariff tantrum last year, right? This was a great time. We kind of did what we do, a huge V, right? That return that we saw coming off that low was massive, and we didn't in U.S. equities. So that would have been a really nice time to leg into some of these longer dated products to take advantage of that weakness, whether it's event driven or seasonal driven. And we have seen investors use it as such. But just like anything, this is a new strategy, so it takes a little time, Nate, to really get out, why this is important, how it's looked at. Investors want to compare the performance during a certain period. So I don't want to say, oh, during this period it did this, it was great. But during periods of higher volatility, we would expect a non-daily product such as MQQQ to outperform the daily reset products such as QLD.
Yeah. By the way, with the path dependency of these products, I remember that last time you were on, we talked about how I believe the analogy you used was that daily reset products are like wearing daily contact lenses for several days in a row, right? Where the longer you keep them in, the less effective they become. And of course, you're contrasting that with a monthly or quarterly reset. I like that.
Yeah, and we've gotten some good feedback on that. It's like, I could probably wear these again. It's I'm not gonna be able to see as well tomorrow, and it could sting on day 4 or 5, but that's really how it is. So it's a lot of it is kind of knowing your exit and entries, trading around events. But again, as I said, we have had probably the best uptake in these non-daily products with RIAs and some advisors who are more tactical. Whether they're looking at charts or other technicals, or with clients who are super comfortable wearing some a little more risk for longer. That's where we've had the greatest interest on our non-daily products.
All right. Before I let you go, I had asked you earlier just about your specific launch goals this year. Can you give us any more detail in terms of what might be next for Trader with launch plans for the remainder of 2026? What should we be watching for?
Well, you could look at our filings, so that would be a good a good way to kind of see what could be in store. So I can't really comment much on those, but I just will say that we have filed for a bunch of stocks that we could expect to go public this year, right? And so you can kind of look at that list. We filed a bunch last week, 2 weeks ago. So that might be the next bastion of where you're going to see some some early first to market strategies from Trader.
Well, Matt, greatly enjoyed the conversation this week. Congratulations on all the success you're having with the Trader ETF lineup. Thank you for joining me.
Thanks for having us.
That was Matt Markiewicz, head of product and capital markets at Trader ETFs.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Christian Magoon, founder and CEO of Amplify ETFs, who currently offers 40 ETFs, over $20 billion in assets. As I noted at the top, they actually grew assets by about 70% just last year. They're one of the fastest growing ETF issuers out there. And Christian is someone who is a true OG in the ETF space. I feel like some people toss around the ETF industry veteran tag. Christian has actually been launching ETFs since I think the mid 2000s. I mean, he has truly seen and done it all in ETFs, and he's now joining me from Colorado. Christian, it is so great to reconnect. Welcome back to the podcast.
Thanks, Nate. We've known each other so long that we go back to the days of radio. That's how OG we are. Now we've made it to video, so that's great. Appreciate being on.
Well, it's so funny you mentioned that, and I probably say this every time that you're on here, but you were actually one of the earliest ETF Prime guests. I think that was back in like 2012, and I could be wrong, but I actually think you still might hold the record for most appearances on here. So I appreciate you always being willing to help educate investors on ETFs. So how's everything been going for you?
Boy, we're coming off a great 2025, as you mentioned, kind of record-setting growth in a variety of areas between some of our growth ETFs, which are about 48% of our assets, and then our income ETFs, which are close to 50% of our assets. So had a great 2025. In some ways, you go back to the early days when we started Amplify in 2016, and we were just hoping to get to $1 billion. And, it wasn't until 2020 that we got to $1 billion. So to have a single year where we grow by $7 billion just seems a little bit hard to fathom, but we're grateful, and we're continuing to just bring out, I think, product that resonates, and hopefully investors continue to think that our solutions make a difference. And we just want to focus on not bringing things that are the seventh version of something that's out there, and instead bring kind of new elements to the toolbox between market segments or investment strategies. So we're going to stay the course here in year 10.
All right. I love it because I feel like every time we visit as well, we are always talking about some new growth milestone for Amplify. And you'll be celebrating your 10-year anniversary in April, right?
Yeah, so yeah, April 16th was our first ETF launch in 2016. If you remember, iBuy, the first online retail ETF, and going back to that point in time, people were saying, well, what could be an online retail ETF? What do you actually own? And people just weren't thinking, hey, there's companies you can own that are e-commerce, and certainly that had its big day in 2020 when the world was shut down and online retail soared that year, just benefiting from kind of the lack of access. And we also launched our largest fund back then in 2016, Devo. So a couple early funds that really have made a difference, I think, for investors and for Amplify over time.
Well, let's actually talk more about some of those products. And to your point, Devo, the Amplify CWP Enhanced Dividend Income ETF, that is currently your most popular one by assets. I show around $6.5 billion. It's clearly resonated with investors. And of course, I would say options-based income strategies overall clearly have been rapidly growing in popularity. But talk more about this ETF and why you do think it's had so much success.
Yeah, well, it was probably one of our least successful ETFs when we launched it in 2016 and 8, because for about 3 years, it's had about 20 or $30 million in assets. It was really one of the first derivative income ETFs that not only owned individual stocks, but then had the manager tactically write calls on individual stocks. Remember, back then it was really index-based products that wrote robotically each month options on indexes. So it was kind of, I think it took a while for the market to figure it out. We have capital wealth planning that we're actively managing Devo. And once it kind of got past its 3-year track record, it really bloomed. They're looking for high quality dividend paying stocks. And at in addition, then they're looking at the ability to tactically write covered calls. So you really have two income engines, if you will. You have dividends and you have option income. And I think the big kind of takeaway from that fund and why it's done so well relative to some of the other large equity derivative income products is it's balanced. It doesn't reach very high for yield. The yield is only less than 5% on the portfolio, but by not reaching high for yield, it has a lot of capital appreciation upside. So its total return is hundreds and hundreds of basis points above some of the most well-known, highly owned derivative income ETFs. And it's allowed it to be a 5-star fund, and really is kind of the calling card for our suite that we're calling YieldSmart ETFs. Being smart about yield, not yield trap, like there's more and more funds that maybe I think take that strategy, but yield smart, and that means simply balancing attractive income, not maximum income at all times, but attractive income with capital appreciation, because we think over time investors need that growth of income, that capital appreciation in their income products. And we certainly have a fairly large suite, with Devo being over $6 billion now, and one of the faster growing funds in the marketplace.
Yeah, and another ETF that's part of that YieldSmart suite that I think we have to mention is that Amplify offers an international version of this strategy as well, right? The Amplify CWP International Enhanced Dividend Income ETF, ticker IDVO. And of course, international stocks, Christian, I mean, they've been on a very nice upswing over the past year and a half or so after being in the doldrums for so long. Anything in particular you would highlight with the international version of this income strategy?
Yeah, I think, for many investors, the 10-year numbers, international haven't been as good, but as you know, the 12 to 16-month numbers on international have been quite compelling in the U.S. IDEVO takes a unique approach for those who might be a little bit scared about international investing, and it does have that dividend and covered call aspect. So you have about a 6% yield making up your total return, and a great illustration of kind of how we're balancing income with capital appreciation. That fund was up over 41% last year as a covered call ETF in the international side. The other note I would make is it is actively managed. And it does have allocations to both developed and emerging market stocks. So, not everybody wants to maybe allocate to international, let alone maybe some to developed, some to emerging. Here's one kind of convenient solution that has had some solid returns. It's 5-star rated, has that dual income element of dividend income and option income, but still allows you to have capital appreciation. The fund has returned over 15% just year to date. So it's able to dip into both of those international segments. And I think that also differentiates it from the competition.
And how are you feeling about international equities moving forward? And before you answer that, I think I need to be clear. Everybody knows this is a prediction free show. We don't have a crystal ball. We're not here offering any sort of investment advice. But I guess more specifically, I'm curious whether you think this recent outperformance we've seen from both developed and emerging market stocks is sustainable. Is this something that we could see moving forward?
Yeah, I think in the near term, it certainly is. I think 2026 could be a great year for international. We all know the difference in valuations. Certainly, all of these roving disruptions of industries by AI here in the US may not be as prevalent outside the US. Also, when you go outside the US, you do have a pretty good exposure in many products to, I think, the core pick and axe play of AI, which is chips. Whether it's TSM or Samsung or SK Hynix, these aren't companies that you find in many ETF portfolios unless you go internationally. So I think, if you do like kind of the AI trade and you feel like you're maybe lightening up going to international, well, maybe you are in some ways by some of these ancillary businesses, but in terms of the core chip component, you really are still getting exposure there. So dollar seems to be continuing to weaken here, and I think with a new Fed chair, we could see that as well. So I think a lot of things are lining up to have that international exposure. Certainly, when we talk to advisors, many had abandoned international exposure or simply kind of given the mantra that, hey, 50% of the S&P 500's revenue is from overseas, which is true, but we're certainly seeing the divergence of the international benchmarks versus the U.S. benchmarks. And again, to see a product like iDevo gain over 40% last year, the domestic version Devo was up in the mid-teens. So pretty big difference even in similar methodologies, just shifting geographies. So we think international, I think, is back and here to stay for at least the short-term future. I think longer term, it's going to be hard to abandon AI and be as concentrated or less concentrated there. So that could, catch up. But it seems like in the near term, there's going to be a lot more disruptions rolling the U.S. markets with the impact of AI and some of the other geopolitical issues that overseas doesn't have as much. So we like international going into this year and is one of our 6 for 26 themes that we put out on our market outlook.
Okay, so we've touched on Devo and iDevo. As I look down the YieldSmart ETF lineup, which I think there are currently 13 of these in all, I have to tell you, I see a number of crypto-based covered call ETFs. I see Bitcoin, Ethereum, Solana, and XRP, which those got my attention. But there are also several thematic covered call ETFs. Just talk more about this suite overall and perhaps how you are attempting a position in what is, as you know, a highly competitive market for options-based income ETFs.
Yeah. So, we have a legacy in the thematic growth as well as the crypto space. One of our first products obviously was the thematic in online retail. We launched really the first blockchain ETF back in 2018, block that many people didn't really even know what it was about back in 2018, and now is a 5-star fund and has maybe 20 ETFs in the peer group. And we really wanted to bring some of those opportunities into the option income space. because we know not everybody wants, full on crypto exposure or maybe full on silver exposure. So, you can couple those growth uh, themes or opportunities with option writing. And that's what we've done in our suite, our YieldSmart suite. We have a junior silver miners covered call ETF. That targets a certain level of option income, and we've done it for Bitcoin, Ethereum, Solana, and Ripple as well. And what this allows you to do potentially is access those growth opportunities, but in a little less volatile way, to not just depend on it being green, meaning only capital appreciation for returns. Certainly, I think most crypto investors right now, in this kind of mini winter we're having, appreciate getting 2 or 3%, 4% monthly yield from some of these option income ETFs we have on the crypto side. In addition, if you're a long-term crypto investor, these products give you dry powder every month that you can then go buy some more crypto with, or maybe even pay your bills, depending on how you're using crypto in your portfolio. So we think this is quite additive. Again, we're employing the same approach here across the YieldSmart lineup, where we're not going for the highest possible yield that you can from these assets and ignoring capital appreciation. Instead, we're trying to balance that, so that people can have that long-term appreciation in areas like cybersecurity, junior silver miners, or crypto. I think that's the smart way of approaching yield, and again, avoiding the yield trap mentality of just buying the highest yielding option income ETFs, and then really regretting along the way when you see a product down, which we've seen some down 60, 70, 80%, because simply these assets were high volatility assets that had very attractive option income, and people provided those products. And for some people, that's great. They knew what they were getting into, but there's many income investors who unfortunately don't know what they're getting into. They're not looking under the hood, right? And understanding some of the risks involved. So again, we think YieldSmart is the way to go. It kind of gives you some guardrails there, capital appreciation, but attractive income along the way.
Okay, so that's the YieldSmart ETF lineup. If we move beyond that, and we've touched on this a little bit, when I think of Amplify ETFs, one of the categories I've always thought about is thematics, right? And if I look at your lineup right now, after Devo, which is your most popular ETF by assets, again, I show three of your most popular ETFs are the Amplify Junior Silver Miners ETF, ticker SILJ, which that now has over $5 billion in assets. It's unbelievable. I think about 5.5 billion. Of course, there's the Amplify Cybersecurity ETF, which you mentioned, Hack. I know a lot of people are familiar with that. And then there's the Amplify Blockchain Technology ETF, which you mentioned, ticker BLOK. Plus, you have a number of other thematic ETFs covering everything from the online retail sector that you mentioned earlier to cannabis, the energy space. I'd love to have you talk about how Amplify has approached the thematic ETF category overall. What's been the broader strategy here?
Yeah, I think the broad strategy since day one is to deliver something that hasn't been in the marketplace before, really a new market segment. And then secondly, kind of asking ourselves, what's the tail for that disruptive or new market segment? We want something that's, 5 to 10 years out in terms of how it progresses. And then third, really lining up kind of the three big areas we see of demand around a theme. And that would be government spending, corporate spending, and individuals. And we have to kind of see that all line up historically for a powerful growth or thematic ETF to work. As you mentioned, junior silver miners was a huge success in the past year, with silver prices rising and having the only small caps silver mining ETF in the marketplace, SILJ, gaining 184% on the year. It was just unbelievable. And as an ETF sponsor, just stepping back, we're a little bit like an investor, right? We're having to select what ETFs we want to represent our portfolio over a long period of time. We're going to have some growth areas that we allocate to in terms of product development, and then we're going to have some more core or income areas. And in general, Amplify, I think, has done a good job over the 10 years of really barbelling our ETF product line, having some very stable 5-star rated option income ETFs and IDEVO or DEVO, and the same side having growth ETFs that represent kind of some real attractive opportunities that may play out over 5, 10 years, even longer, with the blockchains, the cybersecurities, the silver, etc. So, for a small sponsor, relatively small sponsor, I guess we're top to 10% in terms of overall AUM being in that group. But we kind of think of ourselves as a startup. 10 years ago, we were the 115th new issuer when we launched. And, certainly when I first got into the ETF business, I sat with the Wall Street Journal with Claymore ETFs, and they said, do we really need a 15th ETF provider? And that was back in 2006. So seeing it evolve, you've been there for the ride as well. But we think that over time, having this diversified portfolio allows us to kind of take unique exposures and positions that differentiate Amplify's brand, but also bring some unique opportunities to both growth and income investors.
And in the thematic space specifically, I think I know how you're probably going to answer this because I know you well enough, and I know that you love all of your thematic ETFs equally. But are there maybe 2 or 3 that you would highlight right now that you think have particularly compelling stories?
Yeah, so I guess one I would highlight just in this year's market rotation, energy and basic materials have done quite well. And, we have really 2 kind of energy related products. We have USNG, which is US natural gas infrastructure, actively managed. And, natural gas is probably going to be one of the big sources of demand for increased electrical production for AI. And those companies have done quite well. On the other side, we have a natural resources dividend income ETF that also has a covered call component to it. So it's oil, gas, chemical companies with about a 10% yield target between option income and dividend income. So, as the market's rotating here, I think many people have less exposure to energy and basic materials and maybe are overweight technology over the last couple years, but some new leadership is emerging here in 2026. So I think those are timely thematics to take a look at.
By the way, in looking at your lineup, I saw that 2 of your most recent launches are the Amplify Tokenization Technology ETF, ticker TKNQ, and the Amplify Stablecoin Technology ETF, ticker STBQ. And perhaps this is a topic we can cover on my other podcast, Crypto Prime, and we can delve deep. But do you want to talk just a little bit about those? I thought those were pretty intriguing.
Yeah, so again, going back to 2018 when we launched kind of this first blockchain ETF that was actively managed, BLOK, and has kind of been the benchmark in that space. Averaged 18% a year, average annual returns going back to 2018. That was kind of like the core product offering. And as we've seen the conversations around tokenization of assets, or stablecoin being used for payments, whether it's Larry Fink or the U.S. Treasury Secretary. We know that the financial system is changing very quickly. And with some of the legislation that's happened last year and should happen here soon with the Clarity Act, we think that owning the companies and the tokens that stablecoin is going to be built on, as well as tokenization will take place on, is going to be a very unique investment opportunity for investors. So we launched these 2 funds. Their portfolios are going to continue to evolve as more crypto tokens become available for us to purchase that are pure plays, and then the companies that develop this technology or utilize this technology as a competitive advantage start to really ramp up. So we think that those 2 use cases, stable coins and tokenization, are a real kind of future forward positioning. And for most mainstream investors, probably would be well served owning a diversified portfolio focused on those use cases, given some of the unbelievable growth numbers we're expecting, the government's expecting, other research organizations are expecting on the tokenization of all types of assets and the move from the whole payment system into stable coins because of the efficiency, the transparency, and generally the cost savings that are afoot. So happy to be part of the first mover in that space here 8 years later.
All right, so those are the 2 most recent launches. Before I let you go, I have to ask you, and by the way, you've done an excellent job of highlighting the Amplify ETF lineup overall, but I have to ask you about product development moving forward. And I guess the way that I will ask this is, are there any particular areas of opportunities that you see? And I'm not expecting you to give away your entire playbook here. It's a competitive environment, but how are you thinking about additional launches? Because as I mentioned earlier, Amplify has had a very consistent, steady stream of new ETFs coming to market. You've been very methodical, but you've been very thoughtful on how you've approached product development. Just what might we expect moving forward?
Well, we're going to continue to expand the YieldSmart suite, and we actually have a couple filings out there targeting high yield as well as the investment grade market that will add to our stable. We're looking at some unique thematic launches that may be a new way to invest, let's just say, in thematics that we're pretty excited about. Last year, we launched more product than we ever had before, 10 new ETFs. I think this year we'll see more than that from Amplify. We've got so many great partners and ideas that I think the best is yet to come here in 2026, and I think we'll hopefully continue to reinvent some areas in the ETF space and even introduce potentially a new product category. So I'll leave it at that there, Nate.
Well, you have me highly intrigued. When I hear new product category in ETFs, that's always going to get my attention, which it's amazing because here we are, 33 years since the birth of the industry, and we are still seeing all of this innovation. Clearly, Amplify has been a big part of that. Christian, I always enjoy connecting. Congratulations on all the success with the lineup. Certainly wish you the best of luck moving forward. Thank you very much for joining me.
It's great to be on, Nate. Thank you.
That was Christian Magoon, founder and CEO of Amplify ETFs. That'll do it for this week's ETF Prime. I'm excited to tell you that here in just a couple of weeks, I will be at Exchange 2026, where I will be taking the stage and even recording a live episode of this podcast. This is your chance, becoming a last chance, to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. Secure your spot today by visiting exchangeetf.com. Next week, I will be joined by Chris Marangi, co-CIO of Value at Gabelli Fund. So we're going to spotlight the Gabelli opportunities in live and sports ETF, which I'll tell you, as somebody who is a huge fan of sports and live entertainment, I'm definitely looking forward to hearing more about the investment case behind that ETF. So hope you'll join me for that. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.